Hi, this is Jack Crooks from Money and Markets TV. Economic growth around the world is slowing down. And while that's bad for developed countries, it's even worse for emerging markets. That's because in times of economic stress, investors move money from the periphery to the center. The center in this case means the United States, which still has the deepest capital markets in the world. This explains why, even though money supply is increasing in many countries, their economies are contracting. And this contraction will almost certainly put downward pressure on emerging market currencies. In the past, these types of shifts from the periphery to the center have foreshadowed economic crises. As you can see from the gray bars on this chart, money flow to emerging markets started dropping in early 2007, just before the last crisis. And now, the same thing is happening again. In 2007 and 2008, as money drained from the emerging markets, money began to flow in earnest to the US dollar. It appears we may be seeing something similar now. The dollar put in a double bottom last year and has been trending steadily higher since then. And this time, it's rallying from a higher base, telling me that this is the start of a long-term bull market. Some people may argue that we shouldn't worry about the emerging markets because China won't let things get out of control. They think the Chinese government will step in soon with a major stimulus program that will boost stocks and commodities. But I think things may not be so simple. Just look what happened last week when China cut interest rates along with the European Central Bank. Commodities actually moved lower on the news. In addition, there's evidence that China is still reeling from inflation and asset bubbles created by the last round of major stimulus in 2008. The 4 trillion yuan package led to an explosion of loans, which pushed up property prices and raised concerns over the asset quality of Chinese banks. For those reasons, there's a good chance officials realize that more stimulus may not be the answer this time. And if China does not come to the rescue, the trend of money flowing back to the center is likely to intensify. And that could hit the emerging market currencies of the Asian bloc especially hard. If you want to benefit from the coming decline in these currencies, you can sell short the Barclays Global Emerging Market Strategy Asia 8 Index. This fund seeks to replicate the movement of 8 Asian market currencies relative to the US dollar. I'm Jack Crooks for Money and Markets TV. Thanks for watching.